Hi guys, welcome back to my channel, the best place to be wherever you are on your wealth journey right now. Today I want to talk about rental cover calculations. What are they? Why do lenders use them? And how on earth do we work them out? Plus, what do we do if we're not achieving the rent that we need? Okay, first of all, what exactly is a rental cover calculation? Well, let's imagine that we're buying a buy-to-let property for £200,000. Under normal circumstances, we would be getting a 75% loan-to-value mortgage, which means we'd be borrowing £150,000 from the lender and putting £50,000 of our own money down as deposit. The lender then wants to make sure that the rent covers the mortgage of £150,000. So they have their own rental cover calculation that they use to work out whether or not they're happy. Frustratingly, the calculation does vary from lender to lender, but I'll go through a few examples with you so that you can see exactly how it works. Okay, first example then. The lender comes out and says, okay landlord, I understand that you want to borrow £150,000, but we need to make sure that the rent covers that mortgage by 125%. We're going to work that out based on your initial interest rate. So let's just say that the initial interest rate in this example is a 2-year fixed rate at 3.5%. First, we want to work out the monthly mortgage payments. So we do 150,000 times 3.5% divided by 12. This comes to £437.50 per month. So the lender says, okay then landlord, we understand that your monthly mortgage payment is going to be £437.50 per month, but we want to make sure that is covered by 125%. So they take the £437.50 and they times it by 125%. That comes to £546.87. So £546.87 is the absolute rock bottom minimum that your rent needs to be in order for this particular lender to lend you the full £150,000 you need to buy the house in the first place. So if your rent is £546.87, or even if it's £550 per month, then happy days, you can borrow with this lender. Now, one of the problems that landlords are facing at the moment is that a lot of lenders have made their criteria on this a lot more stringent. So rather than covering the rent by 125%, some lenders want the rent covered by 145% instead. So here's our second example. Let's say that we're still borrowing a 2-year fixed rate at 3.5%. Our mortgage payments are still the same, of £437.50 per month. But this time, the lender wants that covered by 145%. They take the £437.50, they times it by 145%, and it comes to £634.37. So in the second example, you need to be getting at least £634.37 in order to get that full £150,000 that you need to borrow in the first place. So just from these two examples, we can see that if we have rent coming in of, let's say, £600 per month, we could easily borrow with the first example, but we could not easily borrow with the second example here because our rent is too low. This is why it's so important to know exactly what the lender's requirements are when it comes to that rental cover calculation in the first place. Now, if you thought the second example wasn't bad enough, some lenders are also saying, okay, never mind any of that, we're not even going to use the initial rate for when we work out your rental calculation. We're going to use 145% and we're going to base it on our standard variable rate. Now, in many cases, the standard variable rate can be as high as 5.95 or even 5.99%. So let's do a third example then, a worst case scenario example where the lender is using 145% rental coverage based on 5.99%. First, we have to work out our monthly mortgage payments based on the 5.99%. So we do 150,000 times 5.99% divided by 12. This comes to £748.75. Now don't forget you wouldn't actually pay that full amount because you would still be on your 2-year fixed rate at whatever low interest rate that was, but this is just the way the lender works it out. They then take that £748.75 and times that by 145%, and that comes to £1,085.68. And that is how much rent you would need in this example in order to borrow the initial £150,000 that you needed to originally buy the property. So again, if you're only getting £600 per month for your property and rental income, you would only be able to borrow using the first example and not the second or third examples. But if your rent was £1,100, for example, you'd be able to borrow in all 3 of these examples. So it would very much depend on exactly what it is that you've got, what type of property it is, and how much rental income you're getting. So how do you know which calculation a lender uses? Well, this is where your mortgage broker comes in really, really handy, because he or she will be able to guide you and look at the rental income that you're actually receiving from the property, or if it's a new property that you're just buying, they'll say to you, how much rent do you think you can achieve for this? And they will find you a lender where the rental cover calculation will fit with your requirements as to what you're actually going to be getting coming in. So if you're only getting £600 a month in these examples, for instance, then that would really narrow the pool of mortgage lenders. If you're getting £1,100 per month for your property, that would really open up the pool of mortgage lenders and you'd have a lot more to choose from. So whenever I explain all of this to people, one of the first questions that comes up is, well, what happens if the valuer downvalues the rent? Now I'm going to cover down valuations and comparables in next week's video, but I will just touch upon it here as well. Normally, the lender will send a valuer to the property to assess A, the value of the property itself, and B, the rental income you should receive. So let's just take our second example here for a moment, which is 145% rental coverage based on the initial 3.5% interest rate. In this example, we need £634.37 to borrow the full £150,000 that we need. Let's say that we do our full mortgage application and we say that we can receive rent of £650 per month, but then when the valuer actually goes round, he says, oh no, I don't think that's the case. I think you can only get £600 per month for the property. So we have a couple of choices here. The first choice would be to get some comparables to challenge the valuer. Comparables are similar properties in a similar area, which are in this example receiving rents of £650 or more. We would gather at least 3 of these and send them to our mortgage broker, who in turn will then send them to the lender, and the lender will send them on to the valuer. The valuer may come back and say, oh yeah, that's absolutely fine. I can clearly see that other people are getting £650 per month rent for a property just like this one, and sign it off, and that will be fine. In which case, happy days, you can still borrow the full amount. But there are a lot of cases where the valuer refuses to be swayed, and then you're stuck with a rental valuation of £600 per month. In this situation, the lender could still lend, but not the full £150,000 that you would need. So to work out how much they would lend to you, you take the initial £600 per month rent and then you work out the whole calculation backwards to give you the maximum amount that you could borrow. So in this example, it would be £600 per month divided by 145%. That comes to £413.79. We then times that by 12 to give us £4,965, and then we take that £4,965, we times it by 100 and we divide it by 3.5, and it gives us £141,871. So that is the maximum that this particular lender would lend us based on the fact that we can only get £600 per month in rental income. So bearing in mind that you had originally wanted to borrow £150,000 to buy this property, your second option here would be to work out whether or not you can afford to put in some extra money so that you can still buy the property. It just means putting in a larger deposit. So you'd need to find an additional £8,128. If you didn't want to do that, or you couldn't do that, then your third option would be to go back to your mortgage broker to see if there are any other lenders that would lend to you based on your £600 per month valuation. It can be very frustrating to have a down valuation. It's happened to me, and if it's happening to you, I share your pain. So the best thing to do is to be absolutely sure of the rent that you can receive. And if that means getting your comparables in advance to satisfy yourself and your broker that that's the type of rent that you can receive, then do that. You know, get them in advance and have a good old look at them. Obviously, if you're remortgaging an existing buy-to-let that you've already got, then it's much, much easier to go through this process because you know exactly what rent you're getting, because hopefully you've got tenancy agreements and tenants already living in the property. So I do hope you found this video useful, guys. Do give me a thumbs up underneath if you have found it helpful. And don't forget as well, do watch these 2 videos up next because hopefully they will help with your wealth journey. Subscribe to the channel if you haven't done that yet. And thanks ever so much for watching this week, guys. Do stay safe, and I will see you in the next one.